Good morning, everybody. I'm Lauren Moon. I'm here with Dawn. We thought with the news this morning and everything going on in the markets, and we're getting a handful of questions from clients, that now would be a good time to check in, let you know our thoughts on everything that's going on and what we're thinking about from an investment standpoint. Does everything cover it?
Yeah, everything. That's all.
So, Dawn, to start off, we wake up this morning to headlines that Russia's officially invaded Ukraine. The markets had an initial panic, which has been scaled back already. How are you thinking about this in terms of, generally, but also MLS?
Yeah. So thank you. Yeah, we thought it was an important morning to come on and have a quick chat. So I actually called for this, as Lauren correctly points out, at like 5 in the morning or so, when futures were down 2.5%, and everybody was, on TV talking about how brutal this is. And of course, you have to start with the humanitarian tragedy, right? My mind immediately goes to being a father in Kiev and waking up to sirens and my neighborhood being bombed. And, they're talking about an air, land, and sea, full scale. I mean, it's just going to be absolutely savage, and the humanitarian consequences I can't even fathom. And I'm sad as a inhabitant of Earth that this is where we are, but it's a very real, dangerous place, and filled with some people who want to do harm to others. And so that's the world we find ourselves in and have to navigate. So then yesterday, I, kind of on the eve of the announcement today, felt the very first sense of kind of real panicky. Obviously, the market felt panicky.
Mhm.
My own inbox looked, and for all the real reasons, right? We have to acknowledge emotionally, the last 12 weeks have been incredible. Almost since the day after Thanksgiving,
Mhm.
the growth complex has been obliterated.
Right.
And I'm not saying that in a hyperbolic fashion. I'm saying that in a real world, bubble bursting, things down 60, 70, 80%,
Right.
not a few, many. So we don't miss all of that. Some of it catches us in different strategies here and there, but the real, depths of our problem is not even a fraction of that. And so all the way back up to MLS, mathematically, it isn't even the worst we've had it in MLS in the last 4 years. I think even to this moment, there have been 4 other times when we've been down more in MLS from peak to now. So I think the scale of concern has to do with the swiftness of it, and the fact that it's sort of the sort of breathlessness of the daily beatings.
I was going to say, I mean, it's been a long time since we've been in a period where day after day is a down day. I mean,
Yeah.
even in March 2020, it was swift, right?
Yeah, exactly. Yeah.
So,
And it's interesting, right? Because we went through 2020, kind of being armchair epidemiologists and trying to figure out, how, what our own response to that was going to be. And now we're all sort of, armchair geopolitical experts and trying to figure out how this current, catastrophe is going to resolve itself. So I thought I would stick to the facts today, right? So we have no insight into Russia, Ukraine. No one can know. And if you did know, you can't know what the market's response would be. What we know is the US markets have absorbed massive damage, even underneath the index level, which is now starting to see massive damage. It's so much broader and more widespread than than you would even probably know from just looking at that, which is bad enough. But I think we can go back to 2 things. Stagflation is bad. It's bad for stocks, it's bad for bonds, and cash is no bargain because it yields 0, and we know inflation's
to remind everybody, is inflation with slow or no economic growth together.
Yeah, it's the worst possible scenario sort of for assets. And so I'm not going to sugarcoat that either if that's the condition we find ourselves in. So I was going to share my screen and I'm just going to focus on two things. So bear with me, Lauren, you can see my screen?
Yes.
Okay, so this is the chart, and I don't know if this will come across, but this is a very interesting chart, which is if this comes across, or if you can stop the video and take a look, this is the year on year change in price of different categories of items. So we've got fuel and energy. You can see crude oil is up 53% year on year. You'll notice that next time you fill up your tank, if you haven't done it recently. Natural gas up 36, gasoline up 61. Now on to livestock, right? We have to eat. Hogs up 22, cattle up 23, chicken somehow down 1% year on year. Then agriculture, okay? We don't want to eat meat. Well, we're going to eat something else. Well, maybe some wheat. That's up 21 year on year. Corn up 20, soy. You get the idea. Cotton, obviously things that go into other things. Cotton, coffee, sugar, all up. Building materials, aluminum, copper, lumber. So point being,
that is inflation.
this is very, it's everywhere. It's everywhere. And so that is a problem. And so that's what the Fed is trying to combat. Now, we go back to when we want to feel good about things or feel like we have to do something. We know cash, going all to cash, if somehow you were right in the near term, then you have to get back in at a lower level, because if you say, well, I'll get back in when things are good again, by definition, that was 12 weeks ago when we were feeling like things were pretty good. That's the wrong time to get back in. So you have to get back in at a better time. By definition, the news will be worse. And it's what everybody thinks we should do in our job is be getting out when we're at a top and getting in when things are at a bottom. It is not, it's a fallacy. So when I look at the holdings of the long view strategy, and I'm not going to go all the way down the list, I'm just going to start with the top weightings. We have more cash than we've had in a long time. Berkshire Hathaway, if you remember back to the last financial crisis, they came out of the financial crisis with assets that made the shareholders, of which we've been since before then, and $100 billion richer by the fact that they bought assets during that downturn. Right. So I don't know what's going to happen with the Kiev market or the Russia market with regard to Apple, but they got to be the largest company on the earth for a long time for a reason. We're all sort of addicted to their products, or many of us are. Amazon, blah, 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 Alphabet, Blackstone. So my point that I always keep bringing up to clients when I'm talking to them is the world is going to look a way in a year from now. Isn't it more likely than not that the way it looks will involve these companies, which should be almost obviously larger companies and businesses than they are today? And so if that's the case, then that should be a portfolio of assets that we're comfortable holding. They're the largest, best balance sheet, most unassailable business model companies in the world.
Right.
Period, full stop, not even a question. So that has to be the core of an approach that has to acknowledge there are certain things that are not knowable about how the next day or week or month will unfold. They're not knowable. So let's not try to guess and get out and get back in and all that stuff. And so, again, in the context of all the other times I showed this screen, Russia invaded Ukraine overnight. Humanitarian disaster. And our 4 key strategies, 2 are now up on the day and 2 are down. And it's almost like, a teeter-totter. If you look at how that picture looks, that is a teeter-totter. And so as you would suspect, our more conservative strategies are in the center of the teeter-totter, and our more aggressive strategies that they're on the outer ends of the teeter-totter. Thus the amplitude I keep talking about. So I'm not trying to be, brush this off as don't worry about it. I worry about it. You worry about it. Every client we have worries about it, as we should. Then we get to, okay, we agree we're worried about it. What do we do about it? We cannot fathom a more logical, unemotional, odds in our favor, keeping volatility at the forefront of what we try to control, basket of assets to hold, or else we would shift to that. We have no reason not to. So that's really kind of where my mind went to today. What are you thinking? You've got, we're in different states. What are you? We haven't talked. We hardly have a script about this. So what are you thinking?
I mean, I think there's new uncertainties about the future. We can't know everything, but I think one thing that comes to question now is the Fed going to change the speed at which they will raise interest rates? With geopolitical conflict and more uncertainty, there's still inflation, but how will that actually go into play? So I think that will be interesting to watch over the coming months. I think if we have prolonged increases in energy prices, electric vehicles are going to be more in demand. From an innovation sector, there could be some interesting opportunities there. So, as the world changes, more opportunities arise, but it's also, we like
Scary.
to play. It's also scary. We don't know how it's all going to shake out. So we always like to err on the side of protecting your assets, protecting our clients' assets than getting too speculative. But those are the things on my mind.
And so I'll leave it on this note, which is a common theme over the last couple of years has been, even clients that are invested in one or more of our strategies, oh, the market's high, I'm going to keep some cash on the sidelines. If you think there's a good buying opportunity, let me know. Well, this is what a good buying opportunity looks like. This is actually what it looks like, because you can't just buy it when everything seems great, because that by definition
that is
this
signal.
is exactly, and this is the sort of fallacy around going to cash, because I was texting with somebody earlier and I said I had never seen a client yet buy it all back lower, because by definition the news is more bleak or rough. And so I always go back to this little example, which is, okay, let's say we're right and we understand exactly what's going to happen with the markets over the next week, and they're going lower by 5%. And so we agree that's worth avoiding. Cool. So we sell it all and now we're in cash. We don't know what happens on day 6, so we buy it all back. We got our 5% savings. We bought it all back. Okay, now the next day there's a down day. Yep. Do we sell it all again? do we wait another day? Do we, so then now we're in this coin flip torture chamber of playing card sharks, big bucks, no whammies, instead of investing in companies that can persist in any geopolitical environment, because they have for many, many, many decades. So we prefer to go that latter path, but we understand it's not a comfortable ride. It is no fun. It's a lot more fun coming into green screens and counting our hypothetical gains and our unrealized gains in our on it. And people have gotten accustomed to that, so it's become part of their daily routine to count the money. And it's so I don't know when we'll get back to that. I just believe that the market hasn't made its last all-time high ever, and the companies that we own will be larger in a year, 2 years, and 3 years than they are today. I can say that's nearly obvious, and their prices over some period of time will follow. So we believe that's true. So that's it for today. We'll leave you all. Hopefully this is the beginning of stability. You can see there is some green. The stocks that are the most bombed out are actually having a nice recovery today. Hopefully that marks the end of, a lot of this has been forced selling, margin calls, people, trading for the first time on margin, literally have been carried out one after the other. And it's been really sad to watch, because those losses are permanent. And I'm glad to say we're not in that group.
All right.
So,
well, thank you, Don.
All right. Thank you, Lauren.